Hi, my name is Joseph Edwards, and I'm in Professor Lewis's International Financial Management class. And today I have a portfolio of 4 different multinational corporations, and my job to you is to explain what made their stocks move over the first quarter of 2015. My first company is Emerson Electric Company. They're in climate technologies, power technologies, industrial automation, electric motors, and network power. They produce products in each of these different services, and they also provide engineering services for other firms. They have a market cap of over $40 billion, so they're a very large company. They realize about 20% of their revenue in Europe and another 20% in China. This is a graph of Emerson Electric versus the S&P 500 over the first quarter of 2015. The red line up here is the S&P 500. The underperforming blue line is Emerson Electric. And if you really analyze this line, you can see that Emerson came into the year very highly correlated with the S&P 500. And then in about mid-January to late January, there was their first divergence for a week or two, and then they had another divergence at the end of January, and they kind of kept that divergence up into mid-February. And then if you look at mid-February until over the rest of the period, the correlation is again very high. These are relatively the same lines. So really, what happened to cause this divergence over here? Over the entire period, the correlation coefficient between the two was 0.66. But if you take out the divergence for the first couple of weeks of February and the end of January, the correlation coefficient is well over 0.7. Regression analysis that I ran in Microsoft Excel did say that Emerson is driven significantly by U.S. market conditions. So what happened in early February? Emerson released their half-year report, which detailed that their net sales were flat. They did have underlying sales growth, but this was offset by unfavorable currency translations, the main currency being the euro. The euro in June of 2014, the beginning of this half year, was at $1.36 per euro. And at the end of the quarter, the euro was at $1.20 per euro. Over this half year, the euro depreciated 11%, and Emerson started realizing less and less revenues. And the day that this report was released, 8,900 June puts on Emerson Electric were bought, and this was 5 times the June strike price's previous volume. So investors became very bearish after this release. The rest of February, the stock was up 1.51%. So maybe this suggests that investors were a little hard in their valuation after the earnings report, and are kind of correcting their valuation a little bit. And also, the S&P 500 was pretty significantly up over February. So again, the correlation was pretty high, so it's being pushed by the market. Over the period, the euro did depreciate. At the beginning of the period, it was at $1.20 per euro, and at the end of this quarter, it was at below $1.10 per euro, so about $1.09, $1.08 per euro. So this graph depicts a 10% depreciation of the euro over this quarter, and Emerson is down 8% over this quarter. The percentage change in their stock price wasn't directly correlated with the percentage change of the dollar per euro, but I still think there is some relationship between them being revalued 8% downward and the depreciation of the euro. But the reason that they're not directly correlated with their foreign exchange, the currencies that they deal in, is because that they do undergo hedging practices. At the end of 2014, they detailed that they had $1.7 billion in outstanding hedge positions, and their 10K report wasn't too detailed on their hedging practices and things, but what it all amounted to saying was that their hedge ineffectiveness was immaterial in 2014, 2013, and 2012. So maybe they lost a little money, they gained a little bit. Basically, the effects of hedging were immaterial, but it kept them from losing more than they otherwise would have. My second company is Cypress Semiconductor Corporation. They make programmable chips, flash memory products, microcontrollers, wireless Bluetooth, and USB technologies. They have a market cap of $4.4 billion, so we're dealing with a much smaller company than Emerson here. Here we have a graph of Cypress versus the S&P 500 and the NASDAQ over the past year. So if we go back to a year ago, these lines are very, very correlated. They're basically the same line, but you can definitely tell that Cypress, I don't know if you can tell that it's blue or not, but the blue line is much more volatile. And I did run the beta of this over, the beta of Cypress versus the S&P 500 over this quarter was 1.4. So they're very volatile relative to the market. And then right here, their stock price shot up from about $10 a share to about $14 to $15 a share in just 1 month. And that was in December of 2015. And to me, what drove this was they announced that they would acquire another main player in the semiconductor space, expansion. The companies are expected to achieve $125 million in cost synergies in the next few years, and that the valuation was valued at $5 billion. But what made, over this quarter, what drove these larger periods of volatility earlier in January? In mid to late January, they released their fourth quarter earnings report, year ended December 2014. And they announced that their operating expenses were at a 15-year low, their earnings per share increased over the year, their revenue increased slightly, and so did their free cash flow relative to last year. But their earnings per share of 13 cents per share slightly missed the mark of projections of 14 cents per share. So the reviews were kind of mixed from this report, and so you can definitely see up, down, up, down. Some investors are bearish on the stock, some investors are bullish on the stock. So mainly just, again, a lot more volatility with this stock. In February, the stock was very, very stagnant. This does not represent much of a change at all. And the stock actually opened February at $14.75 per share and ended February at $14.75 per share. So not too much went on, really. And then in March, you see our first big jump occurred on about March 12th, and that's when they actually fully acquired Expansion, which the market reacted very positively to for a few days. And then the stock just began to be hammered for the rest of March, down from its high of $15.75 per share down back to about $14 per share. I was wondering what made them fall this much. There was no news that was released directly linking them to anything negative. So I started to look up semiconductor tracking indexes, and I found the SOX, which is the Semiconductor Sector Index of the Philadelphia Stock Exchange. Components include Intel, Skyworks, and Texas Instruments, so other players in the semiconductor space. Cypress is not even a part of this index. But in the month of March, Cypress was over 73% correlated with this semiconductor index. So it's being driven by its sector. And if you look at the days where the stock really began to get hurt, the correlation between Cypress and this market was virtually 1. These lines, you can't even tell that this is 2 lines right here because they're running together. So that's what really drove them down. The best I could find on what was going on in the semiconductor space is that I found Jim Cramer talking about how the long-standing decline in personal computers is really hurting the space. But Jim Cramer is actually still very high on Cypress, so I don't think there's too much to be worried about as far as their future valuations go. And as far as their foreign exchange dealings, 30% of their inputs come from the Philippines. In the last year, the Philippines has stayed within a 3% level of 43.5 Philippine pesos per dollar to 45 Philippine pesos per dollar, so it's stable. 20 to 30% of their income comes from China, the Chinese currency, always very stable, and 10% of their revenue comes from Japanese firms. And the Japanese yen started the quarter at 119 yen per dollar and ended this quarter at 119.5 yen per dollar. I don't know if they're managing it right now or not, but so the Japanese yen has stayed relatively stable compared to the dollar and shouldn't have hurt any valuation for a company dealing with their currency. And their notes, out of all the companies I tracked, their notes were the least extensive on their hedging practices. What they amounted to saying was, we might hedge sometimes because we deal in foreign currencies. So there wasn't too much there. But nowhere in their notes did it say anything about them being adversely affected by foreign exchange. My next company is my first ADR, and it's Sony. They're a Japanese company, and their main profits are from games and gaming systems, and then camera imaging sensors that go in smartphone cameras. Here we have Sony versus the benchmark Japanese index, the Nikkei 225. This bottom line, this steady, slightly upward blue line, is the index, and it was up 8% over the quarter, and Sony was up about 30% over the quarter. So what's making Sony do so well? They've released a lot of positive news over the quarter. They received positive reviews for their smartwatch. They cut jobs in their smartphone workforce, and they will have cut 30% of this workforce by 2016. This is actually a huge deal because their smartphone was a flop, and it is nothing more than a balance sheet burden. So anything, any news about them scrapping or scaling back operations in this, the market will react very positively to, because it will reflect better on their financials in the future. In February, they announced a partnership between them and Marvel. The Marvel movies have been lucratively profitable, so this will help future cash flows in that segment of their business. In late March, they began selling PlayStations in China, and China lifted a 14-year ban on gaming consoles. So right now it's basically a race between Microsoft and Sony for who can infiltrate that market and capture most of the market share there. But either way, they have 1/6 of the world's population now open to them buying their products. And they also announced in late March that they'll spend an extra $45 billion on to boost camera imaging sensor productions, which, like I said earlier, is their most profitable business. And the iPhone actually uses these camera imaging sensors, and we all know how well Apple and the iPhone have been doing. So then, if you go back to the chart, you can see a huge leap in their stock on February 2nd. Their stock increased about 10% over the next few days, and then continued February up. And February was their most lucrative month at a 21 to 23% gain. So what happened on February 2nd was they released their third quarter earnings report, which their third quarter ended last December. Their operating income loss it was cut in half. It was revised from a $40 billion yen loss to a $20 billion yen gain. Their sales beat estimates by 6%, and they projected their highest future earnings for the year ended 2018. the future looks very bright for Sony, and they're being valued very highly based on future cash flows. The yen, they do realize about 20% of their revenue from Europe, and the euro was down 10% over the period. It went from about 145 yen per euro to about 130 yen per euro. But their stock was up 31% over the entire period, so there was virtually no correlation at all between the two. This could be because investors realize that this right here is very, very short term, but their projected earnings 5 years into the future are what is really driving their stock. And then another reason they're not correlated is because they have been very transparent about their hedging techniques and their hedging reports. They had a $3 million yen gain on 2014 hedges, which equates to be about $30,000 to $40,000. So not too much gain from hedges, but they are mitigating what would otherwise be decent losses. But their currency dealings and their hedging, that's not what's driving them right now. What's driving them right now is high profitability and their major product wings. And my final company and second ADR is Diageo. They are one of the largest global spirits sellers, so they sell liquor. Notable brands include Guinness, Smirnoff, Crown Royal, and Captain Morgan. And they're headquartered in London and traded on the London Stock Exchange. Here we have a graph of the percentage changes of Diageo versus the FTSE 100, which is the benchmark index on the London Stock Exchange. You can see Diageo is the blue line, and the index is the green line. And you can see that in January, the two lines, they aren't the same, but they're very highly correlated. They're doing almost the exact same thing. Diageo is a little more volatile. And then Diageo spikes before a major sell-off where it peaked at 129.